India's economic growth is stalling as consumer demand is slowing. The broad expectations from the budget include a boost to consumption through corporate and personal tax cuts. Here's a report.
India's growth story is showing signs of cracks. Analysts expect the government to do something about it in the upcoming budget later this week. According to Nomura Holdings, the government is predicted to unveil business tax cuts in this week's budget. This is to revitalize a flagging economy. If put into action, the proposal may alleviate investor concerns by increasing business profits. However, concerns over such policies' efficiency is promoting growth have been raised. Private investments have not yet recovered after the significant cut in corporate taxes in 2019. Signs of a slowdown in broader consumption are highlighted by Hindustan Unilever's lackluster earnings in the December quarter. This has the middle class looking for some tax break. Will the government give in to the middle class hope to boost demand? Poor revenue outlook and profit miss have been the narrative in the latest earnings round. For stock market bulls, this earnings season is shaping up to be a replay of the second quarter, signaling further downgrades. Indian stocks have taken a beating with the $2 trillion rally in the Nifty index showing signs of cracks. A slowing economy, delayed government spending, and shrinking corporate profits have fueled a sell-off in domestic stocks in the new year. With the budget around the corner, the government has a chance to reverse the flagging investor sentiment. The real question is, will it grab the opportunity? Business Bureau Report, we on World is One.
Mr. Subhash Chandra Garg is a former Finance Secretary of India and author. He is now joining us live from New Delhi. Welcome to the broadcast, Mr. Chandra Garg. Let me just get from you, what are your expectations from the budget, which is just around the corner?
So thank you very much. See, this situation, as you have outlined in the run-up to this show, is economic situation is terribly bad, quite bad. At the same time, the government's own financial position is a little difficult. The tax growths have slowed down. The GST is below 10% now. Corporate taxes have been, in fact, in the negative growth for some time. Only the income taxes have been doing reasonably well. They are also expected to sort of show signs of flagging in times to come. So in such situation, when you have your firepower, which is much smaller than the economy desires, it is difficult for the government to so pump prime the economy by sort of boosting consumption or providing a stimulus. So my sense is that the government will probably continue on the path of fiscal discipline by sort of cutting down the fiscal deficit to 4.5%.
Mr. Garg,
which in a way will constrain its... Yes.
Sorry, you were making your point there, but just as the continuation of this discussion, what do you think the government will focus on this time around? Is it fiscal discipline, like you mentioned there, or expansionary policies?
See, government would definitely like to do expansionary policies as it has been doing in the past by expanding capital expenditures. But the resource availability constrains the government. So I don't think the government is in a position to do expansionary policies this time around. It will have to sort of constrain the fiscal deficit to 4.5%. And that would have some implications on the capital expenditure as well. It is evident during the current year, the government has not been able to spend 11.11 trillion rupees of capex budget, which it had for 24-25. So my sense is that if it is not being able to do it this year, even if it wants to expand next year, it will be constrained. So I don't think there would be expansionary policy in the budget. It will be more of a forced fiscal deficit. Discipline.
All right, Mr. Garg, thank you very much for your time and for your insights and talking to us today.
Thank you very much.
For all the latest news, download the WION app and subscribe to our YouTube channel.